Welcome, everyone. It is Sunday night. Kindle Report will start its normal week. I may have time this week to do a live cast on Wednesday like I did last week, but I'll let you know on Tuesday night. So, um, there's a lot going on this planet right now. And, looking back on last week, unemployment was bad. The headline number was bad, but they revised the previous months, so it wasn't as bad as it looked like. And we did see markets all over the place again, and that's going to continue. This volatility is going to continue. And tonight we were traded down to 43.52 on the futures. Now we're 72. So we've ran 20 handles off the lows, but there seems to be a fair amount of activity. But as we come into this week, it's going to be about most likely the CPI. FOMC meetings is coming out. The minutes are coming out. There's some other things. I'll go through details here. But we're also starting earnings, and the banks are going to lead the way. So I was debating with myself where to start on tonight, and I think what I'm going to do is start with a review of last week and Friday, just what we saw last week. The S&P finished up 0.8. NASDAQ was up 0.1, and the Russell down 0.4. So kind of a mixed week, I guess we'll call it. Nothing really that drastic. It was really a recovery kind of from some of the weakness that we've seen over the past several days and last couple of weeks. Actually, we just continue to see this sideways chop. There's just nothing there. And I've been talking a lot on the channel about something I believe is going to continue to happen. I mean, I just think the economy is just going to hit an absolute wall. It's going to run straight into a brick wall. And not only will it be slowing, there'll be some other elements that come out to play, and we'll have possibly slow moving economy, or maybe even, I don't think it's going to go negative. I'm not quite in the recession category just yet, but I do think there's some substantial things that are starting to show up that are going to be significant. And, we come into this week in earnings. The good news is I've been talking to you a lot about some of these, the small cap and the Russell, and we did see two areas actually really strong last week as well. The energy and financials were the two strongest sectors last week. Let's see here. They were, I believe, up. I didn't mark down what they were. They're up about, I think, almost 3% on energy. Energy's continuing to be a hot spot in the markets, and I don't see that going away. And we'll go through the energy here in just a few minutes on what my expectations are. But we've got a fair amount of banks. I think tomorrow is a holiday, Columbus Day holiday for non-U.S. people. The banks are closed and the bond market's closed, so we're not going to have any influence by interest rates tomorrow anyway from that standpoint. So we'll have to kind of a neutral day there. All the government offices are closed, but the stock market is open. So we'll see how this all flows as we go through the day. Expectations are somewhat muted from my viewpoint, and I'll go through the technicals here in just a few minutes. But we look back on the unemployment numbers also. This was the interesting number for me, was that the unemployment number actually dropped from 5 down to 4.8%. And how did it do that? Because people are leaving the workforce. They just not even looking for jobs. And what a great way to measure it. So if no one's looking for a job, you get to say unemployment decreased, right? Well, if you took those people in accounting, then you'd be unchanged, maybe even up on the month. But they're going to continue to use this. It's an old trick by the Commerce Department. That's the way it works, and that's what we have to deal with. But everything was kind of dismal, to say the least, as we look at that unemployment report. Even though the revisions came in, a lot of folks are trying to put a positive spin on it. And one of the things I'm going to talk to you about this week, as we kind of go through the week, is stay focused on this whole Fed taper situation, right? And I am in complete disagreement with just about everybody on the metric that the Fed is watching. Now, the metric that everybody's talking about the Fed is watching is the employment situation. And even though the last 2 months we've missed, there's enough employment coming in that the Fed's going to go ahead and taper. And I think I discussed this a little bit for those of you that came in on the Zoom meeting on Friday. That was great getting an opportunity to talk to a lot of you and to do that. But the thing that I'm seeing here is I'm going back to old school. I've been watching the Fed since around 1979, intensely starting 1980, because that was what you did back in those days, similar to now. But the Fed is always, in the past, not always, there have been times where they've intervened and led the market. Most of the time they follow the market. So the question is the dog wagging the tail or is the tail wagging the dog? Since Bernanke, we've seen the tail wagging the dog. Otherwise, the Fed's been leading QE and all the other programs, especially last year on the big, all the purchases they did, not to mention adding four and a half plus trillion dollars into the currency. So they definitely were leading the way here. I believe what's happening is the Fed will start to raise rates, but only when the 10-year starts to be around 170, 175. I'll go into some more of these details, but the Fed is going to be forced to adjust the short-term rates to the market. This is how it's worked. And most of my career, prior to Ben Bernanke, Helicopter Ben started this, and the TARP and the Great Recession, that is how it's always worked, is that the Fed, the markets would go up and then the Fed would lag. And all that's what I'm expecting to see here now is market forces are going to lead the Fed to do what they need to do. And it's maybe employment is part of the consideration, but I think it's more about adjusting market rates to what's going on in the economy, or more importantly, in the pricing of interest rates. So that brings in to the big event this week, which will be CPI and PPI. And I think it's interesting. CPI is expected to come in at 0.3, PPI to come in expected at 0.6. And I think these numbers are going to be a bit revealing. And we all know, anybody that's been out in the economy knows that you probably, inflation is much higher than 5.3 and some of these numbers that are out there. I mentioned in the Zoom meeting on Friday that I have a particular staple I buy. I go down to the Valley to buy it, and when in 6 weeks' time, virtually the same amount of purchases, the prices were up almost 20% in 6 weeks' time. Now these were, meats and fish and those type of things, but these higher end staples in the stores, they're just skyrocketing right now. Now it's going to continue, and all of this stuff, the reality is this is going to continue, especially with the pressure with oil and all of these things happening. So the Fed's going to move probably in November as everybody expected, but I think it's for a different reason. And my reason is going to be the inflation and also just market rates. We're seeing some backing off on treasuries, more treasury sales. We saw it print up at 160, and I still like putting the watermark. The high watermark is around 170, 175. That was the old high that we had, I believe, back in March. I'll review that in a minute. But those are the things that I see happening as we come into this week. Let me just look at a couple other notes I have to myself. Yeah, so let's go through. The earnings primarily are going to be focused on the banks. I believe it's Wednesday is led off with JP Morgan. Then we got BlackRock, B of A, Wells Fargo, the Goldman, Citi, PNC, US Bank, a bunch of them coming out toward the end of the week. And then ultimately on the economic side, we're going to have JOLTS coming out on Tuesday. Monday, all the government offices are closed, so nothing will be out tomorrow. And then we'll have CPI on Wednesday, PPI on Thursday. Also, we'll have claims expected to show like 323, and continuing claims came in at 2.71 million. My marks that I'm watching is greater than 3.0 or less than 2.5. I think we're locked in this range for a minute. And then Friday, we get retail sales, and there's expected to be down minus 0.5. So we're looking at negative sales. And I guess my theme, if I had to put something on it, would be that I think we're going to continue to see things slow down. This so-called reopen trade is just not a thing, I don't believe. If I'm proven wrong, that's a good thing. But the markets are, I believe, are going to be a bit surprised by some of these numbers that come out just based on the rhetoric that you see on any of the mainstream financial stations, the CNBCs and Fox Business, all of those guys, just about everybody that's coming out is actually telling you that everything's going to be fine. And just one more comment, kind of all over the place tonight, but one more comment on the earnings is I think earnings this season are going to disappoint. With all these supply chain, there's a lot of other things happening out there that are going to disappoint the markets. We don't have to worry about any of the so-called tax increases, even though they had this 133 or 135 countries agree to raise taxes. That's sort of a joke, I think, from the standpoint of being a positive for the U.S. The numbers I'm seeing is it could be a net negative. The U.S. isn't going to pick up as much as Janet Yellen says we are. And I probably think if I had to pick somebody who I thought was the person that could do the most damage in the economy right now, I'd have to pick the Wicked Witch of the West, Janet Yellen herself. She has become quite evil. She never showed this side of herself before, and now we're seeing exactly what she believes in, her agenda. Everything is front and center, and that's why I would probably be worried if I was Jay Powell about my job going forward because of all that. So I think I covered everything on my opening comments that I want to talk about. I'll go through the review here in a minute, but the metrics on our database are starting to deteriorate very quickly, and I'll go through that. Let's go ahead and dig into that right now. So I'll bring you up on full screen here. And the long-term or the intermediate database is at 38.94. You folks know the number. The magic number is 42%. This is very interesting. I'm going to bring you to a page I don't normally show very often, but I'm going to go to the home page on WaveTech and bring up this graphic here because I want you to see what's been happening here. We hit a peak of the percent bullish way early, and now you can just see it's declining. It's the same kind of very strong decline that we saw right before the rollover in 2020. But I'm going to blow this up just a little bit so you can see it. Same thing happened. Same thing over here happened 2018 fourth quarter. Same thing, happens every time. And when I see our database starting to crumble like this, I think we're going to see further attrition as we go through this week. And what this tells us is that there literally are not very many trends in the markets that are hanging in there. Let me go back to this research page so you can see this. Is right now there's only 6,359 symbols. Now this is mutual funds, bonds, equities, the whole bit. That is everything. 38.94%. So there's 10,000 stocks non-trending or declining, while there's only 6,300 actually moving up. So this would be symbols in general. So the other thing I want you to see here is we're hitting some extremes on the sectors. For instance, capital goods, 212 to 11. This number to the right of is the typical holding period for these particular sectors in our database. Now, these are custom sectors that are built through our software. But we're looking at here 344, 427, 217 is 274, and energy's got a little bit more to go on average. A couple of these aren't too bad. Financial are still looking fairly good. So the fact that the database is rolling over, and what I'm talking about here, I just want to make this clear. This doesn't mean the end of the world, a 2020 collapse is happening, or fourth quarter 2018, but this is the type of configuration that sets up before that. Now, I can tell you, I could go back if I had more data. I could show you back. This has been the case every time. This was the case in first quarter of 2000. This was the case in 2007 when we came to the all-time high. When we came into 2008, this database had already signaled that had most of our portfolios that we run, which are literally 10,000 portfolios plus, were in 40 to 60% plus crash. That was the end of December of 07. We came into the first week of 08, had I believe it was an 8% decline the very first week. We were already protecting our assets. Same thing happened, all of these events in 2020. We came in when the February snafu happened and everything rolled over. I remember our institutional clients calling us going, "Hey, Bob, why are we seeing so much selling going on?" I go, "I don't know, follow the magic ball and just do it. Get into cash." Well, it ended up to be a blessing. By the time February 23rd came in, we were heavy into cash, and you know the rest of that story. We're seeing that type of rollover again, and it's interesting because if you turn the clock back 1 year from right now, this is around October, November was when our intermediate models were buying. So our short-term models picked up off the low around March 23rd into April. We picked up a lot of symbols there on our short-term signals. And then it started to happen a little bit in around July and August. Last October, November, and this December everything was buying. So here we are, roll a year forward. Typically, if I were to bring up some of the stats, I'm just going to tell you about them right now, is what happens is we get to the average holding on our, let me just put it up here. I know it'll be somewhat small to see. I'll go full screen so you'll have a better opportunity to see it. But on the right-hand side of the screen, is at the very top, average days long. So our optimized weekly, I'll highlight that, 202 days. I'm gonna attempt to zoom in. Yeah, so I highlighted it there. 202 days are typically what's there. Our weekly 3.2 is 218 days. Those are trading days. There's about 222 roughly days in a year. So what happens is we've gotten most of our trades. We've got most of the trades getting to that 200 plus window. And I've been talking about this off and on for the last several months, looking for a rollover. We were literally, I believe 3 weeks, maybe 4 weeks ago, we were pushing that around 55% bullish. It was hanging around 60%, and now it went to 55. But you saw that chart I showed you a minute ago, that the decline, it was at 80 as we came into the beginning of the year. So it's just been a straight out decline. What that means is fewer and fewer trends being recognized by the models. And when that happens, you can see what happens. Sorry to go into a long explanation of this, but this is what we're seeing. This is the metrics that drive the analysis that I do, and it's going to keep me in a reasonable, cautious mode in this market. Now, maybe it cycles. One other thing, let's go to the daily. I want to show you this as well. So if I go to the daily, we did see a little bit of buying. I'll just give you the numbers. On the weekly, we saw 1,326 sell signals, 290 buys. That took us from 42.8 down to 38.94. On the daily, we're at 26.44 4, we were at 2487. So a slight uptick there, 543 buys versus 210 sells. And all that, this is what I've been talking about. All we're seeing is a rotation, a bottom fishing kind of rotation on the short-term database. We have to get over 42% to even get a sustained setup. And what's happening, and this is important, that's why I'm spending so much time on this tonight. What's happening is that there's been roughly 5 cycles of the short. So when we go along the 200 days, the typical cycle for the holding period on the dailies is around average 40 days, 40 market days, so a month and a half. So what happens, we've had these up and down cycles, and you hear me talk about them every night over the last year. We've had about 5 cycles within one intermediate cycle. So what happens here is we get this type of intermediate cycle to set up. Now what's happening is we're going to see the inverse, where the intermediate cycle starts to cycle down and there becomes fewer and fewer trades actually, or trends in the markets, and that sets up a more vulnerable situation. So that's why I want to spend enough time on this that you folks understand the metrics of what's going on. You can draw trend lines on index charts and everything all you want. This is much deeper analysis so that you understand that when you start looking, I've said this before, when you can monitor 16,330 symbols simultaneously and get these trends, you have to understand from my perspective, this black box to you, from my perspective, it's everything that I designed, everything I believe in when I talk about the PPMs and all that, that causes me to have the opinions that I do. And this is what's setting up. So I'm glad I had the opportunity to do that. I went a lot longer than I wanted to because we still have a lot to cover. On Sunday night, as you know, I try to keep it around 50 minutes to an hour. So we've got some more things to cover here. So let's start to dig into some of the indexes here and get things going. Let's go to So when we look at the S&P, we're only down 750. Like I said, we've seen a pretty decent 22 handle rally from right after the open. So there's definitely some buying going on. The PPMs are trying to set up some potential bottom here on a short-term level, just from an index standpoint. I still think there's going to be, I'll show you on the weekly here in a minute, there's a lot of potential resistance here. From the range of expectations today, and just looking at market grid, let me get that number there. Here we go. So S2 4351.75, low 4352. I had these numbers out for you folks that are subscribers long before, right before the opening of the market tonight. So we printed an S2. The probably extreme would be a possibility of trading an R1 43.96. But it's interesting that with this little rally that we've seen, the PPMs are trying to turn up. They're actually very neutral on this basis. And there's 2 dots that I'm pointing to right here. And these are a cycle event that happened. And we're trying to figure out what the event of the cycle. So the high was 44.21. If we penetrate through that, would be a sign that we'd have a low. The first cycle warning was way down at 42.73. So on the futures, it's pretty hard to signal a top here. So it looks to me probably more of the same, where we get back where some of these other numbers generated. We're going to continue to stay below this number here at the 40-day moving average, 44.28. That's going to be right at that extreme. So it's a possibility of a rally, at least for today, up to that 96 level. Let's go ahead and take a look at the weekly charts, and just so we can get some expectations. talked about this the other day. 43.58 is the 21-week moving average. We closed at 43. Let me get the right number here. We closed at 43.82, so we managed to stay above it. We traded well below it last week, but we're able to rally back. And so here's a couple numbers here. I just mentioned 44.28, 44.32 is a 10-week moving average. And like I said, all of these PPMs are very neutral here. So it's very likely that we could stay in a sideways range. This 21 period moving average has got an upward slope of 0.26. So that tells us there's still about a 40% probability that we'll stay above that level for now. So let's go over to SPX. I know I got a little long-winded on that database situation, but I think it's important to understand. So SPX, we'll do top-down. We'll start with weekly numbers here. We look at the weekly, and what we're seeing here is, once again, 43.91 was the close. 43.63 was that 21 period moving average. So you have to bear with me. I'm trying to click around, but my friendly trade station is frozen. Okay, it's working again now. But so the range expectation from an SPX viewpoint on this would be 44.29. There's another 28.30 number. S1, R2, S1 is 43.53, R1 44.29. We printed the best part in S1 already. So we could start to move. A lot of things are pointing that we could get up toward that pivot level up at that 44.28.30 level. So I'll be watching that as we go through the week. Okay, so let's bear with me 1 second. I've got to start something. Okay, so let's go to the daily SPX. So the 10-day moving average 43.62, closed 43.91. So we're staying above that 21, 43.99, and then the 40 is up at 44.41. Like I said, for me, that key pivot on the upside is going to be 44.20. I don't see us getting much beyond that right now. The daily expected range for today would be 43.79 with a R2, maybe an S1 R2. If we maintain where we're trading right now, that should be the range. But I think the volatility has kicked up enough that we could see even a range of an S2 R2. So watch that one closely. Okay. All right, let's dig into the NASDAQ. NASDAQ is actually a much different profile, and I would argue that maybe this is still the leading market. We're trying to get some PPMs to turn up here. It's kind of encouraging, but the PPM1 is in minus 0.29, so we're still in a trend mode. We're kind of hovering. 14,728 is that number. We're trading 14,769, so we're just above that a little bit. As far as the range for today goes, we're looking at probably S2 R1, that's 18,870 to 14,677. We printed down to 14,704 so far. Let's take a look at the weekly chart, because this is actually even more revealing. There's still support, and I talked about this. This 21 period moving average is still the primary support line. So 14,795, we're trading 14,776. We're trading right on it. As far as the weekly ranges go, we're probably looking at an absolute extreme here at an S3, but right now we're trading basically S2. R1 is 14,968, and this is a NASDAQ futures weekly. The other thing that's happening here, we got a warning signal last week as a potential cycle coming in, and depending on how we trade after this cycle, which will put us at the 15,001 level, if we can close above that on Friday, that would be a bullish sign, and we could start to trade back towards the 10-period moving average, 15,169. So I'm going to try to get rolling a little faster here to make up some time. We're looking at the Russell Weekly right now, and I've continued to talk about this 22,050 number. All of the moving averages on a weekly basis have congregated between 2838 and 2238 to 2239. They're all right in that same spot. PPMs are trying to turn up, and I still will argue that if the Russell can get some traction here, that we're going to see, we could see the market turn around and still move higher in this pattern. And just to go back and make a comment just for a second here on the database, I've talked to you a little bit because I want to tie all this together. The database pulling back from under 42% just tells you two things: that the rally is going to be very narrow, and it doesn't mean it can't continue sideways with a slightly upward bias. There's a difference between trading an index and managing your money as far as how you're positioned and how much cash you might have and other elements within the portfolio environment. But this pattern that we're looking at here potentially can be a bullish one. We've been sideways, really kind of sideways to down going back to March of this year, and it's been a big consolidation. And just watching for that, we can't seem to stay above this 2250 number. We'll see if we can get some movement above there, but for right now it doesn't look like that's the case. So let's take a look at the spread. Let's look at the Russell versus the NASDAQ. The spread is kind of faltering a little bit, but I think this base that was built is going to be enough to hold this. So I still want to see the Russell take a little bit more lead to tell us what's likely to happen out of this pattern. So it looks like, just to kind of summarize all of the index review that I just did, is it looks like we've still got a fairly good base at 21-week moving average on the S&P, on the NASDAQ, and even on the Russell is still showing the type of characteristics that's going to hold the market stable. So we're likely to just continue to work a wide range, and we're likely to see any of the rallies be met with some selling. I don't think we're going to have the kind of impetus to move this thing higher. I guess maybe if the CPI or PPI come in negative, then maybe that would be enough to explode the market, because now inflation's over and all of that stuff happens. So, there's potential bullishness out there, and maybe the midweek numbers that are coming out could be significant. So I'll be watching this every night just to kind of bring in that perspective. All right, so let's move on. Before I go on to the next charts, what I want to, we'll set this up. We're going to go through the 10-year. I'm not going to cover the Dow tonight. I've pretty much covered that. I just look at a Dow staying stable above 93.5. But I'm going to go through the 10-year. We're going to do crude oil, and then we'll do gold, and I'll finish with Bitcoin. So we got 5 markets. I'm going to roll through here. We're about 35 minutes into the show tonight, so I should be able to get this all done pretty close to time So let's go ahead and take a look and start to dig into this. So this is the weekly 10-year. A couple of things I've been talking about. We're seeing a massive acceleration on these PPMs down here. You can see they're just exploding. PPM 1, 2.74. Anything over 0.25 is bullish. This thing is just screaming. And if we look at the potential ranges for this coming week, we're looking at R1 is 163, R2 167, 171. It's very easily within the confines of the market grid to be printing up at 171. And I think at some stage when we get up somewhere around 167 to 171, that's where equity markets will start to pay some serious attention. And that's likely to be the trigger point. And like I said earlier with my talk about the Fed and what I believe is really driving the Fed will be these numbers, not the employment numbers, because they're going to have to adjust to this. Because if you go back to October a year ago, we were looking at the 10-year, let's go to October a year ago. The 10-year was at, let's see, it closed at 0.84. So here we are at, 1.6. It's basically have doubled the yields in that time. So it is definitely getting to the point where there's going to be a strain to do this. I'm going to show you a monthly graph so we can look at some secular stuff that's coming in and a couple things. There's going to be a lot of resistance around 167, 171. I think we could stall at these levels. I don't see us punching straight through, but this is the point between this level is where we're going to see the high water mark. As we go through this month, we've already seen a 146 low. That was an S1. So far, we've seen basically an R1, 160 and change. So R2 is 182. So that would also put us right at, sorry, I said 182, 168. And that would put us right at the 40-month moving average, which is 1.67. So this is going to be one of those points that I often talk about where we get this a number of resistance or support numbers, in this case resistance on yield, where we should start to stall out here, maybe set up a range. I'll try to identify that we see this happen, but this is what I see happening, and this is the thing that I believe once we get above the 170 level plus, that's going to be what really drives the Fed to make a move. But if you look at it, like I said, if you go back a year ago, rates have doubled. They went from 0.84 to 1.6. So there's a lot of upward pressure here going on in the marketplace, and I believe that's going to be the driving force. So let's have some fun and talk inflation and talk about crude oil, and we're printing at 80.48 right now. I think my friend Kathy Wood was telling us it would never go over 76 or 74, whatever the number is. Well, it's probably going toward this is a monthly chart on crude oil. It's probably going to ultimately move at least minimum around 94 to 106 on the upside. These PPMs are just off the map bullish. I mean, this is a monthly PPM, so this is the beginning of a larger secular trend. And I've talked a lot about this in the past, is that this is not going to be, I don't believe it's a demand-driven situation. I believe it's going to be a supply disruption. like what we've seen already in Europe and in China. I think it gets way worse, and maybe there's enough contagion with shipping and other things that maybe even the U.S. gets hit with some of this. And this ultimately, I saw somebody post some California prices. Of course, they probably picked the highest station in the area, but $8.50 a gallon. And all of this stuff, and everybody knows it, hurts the people with the fewest amount of money, right? The poor people will get hit. Imagine $8.50. You know, in 1973, I remember when gas was 25 cents, right? For $5 you could drive your car all week. It was crazy. So this is going to be a big event economically. This is going to cause some things, some real costs in the market, especially if we do see the prices that I'm talking about. And there could even be, if there was a serious disruption, there could be a spike in oil that would be, probably wouldn't last long, but it would certainly send shock waves. It's like throwing a big rock in a pool. It's going to send waves all the way across the entire pond, right? It's just going to just shake up everything. So if we did print, 110, 120, not saying we're going to, but if there was a spike in prices, even when they come back down, everybody's going to be shell shocked. So this market looks to me like it just wants to just rocket here. I'm going to go back to a weekly chart here so we can see this, but same kind of metrics. ppm1 1.81, 1.21 on ppm2, and 1.12. All three of these moving averages and that angle of attack are huge, and these things don't roll over overnight. These are trends that are going to stay in place, especially on the secular trends that I just discussed on the monthly. The short-term trends are maybe in a point where we could hit a bit of a wall. I'm just going to bring up the daily, but even the dailies 0.68, 0.72, 0.45. So the key support in this pattern is 77.33. If you were a trader of oil, you would want to be buying both hands at that level. And that number is changing every day by about 50 cents per day. So in about 3 or 4 days, the 10-period moving average is going to catch up with the action. Maybe at that point, and I'll be covering it every night, we'll get to the point where maybe this thing is a point to roll over. All right, so let's go to gold next. Gold doesn't seem to be able to get much out of its way, but let's take a look. This is the daily gold. We've just been sideways now. For 6 sessions, we've been in a very tight range. We're staying above the 10-period moving average here. It's starting to actually turn up. ppm2 is trying to turn up. So if we can get back above, we're close to it, 1763 on a daily close, we'll start to see the ppm start to turn up and ultimately head towards 1781. And the magic number in the pattern continues to be 1800, maybe 1805 range. We need to get back into that range to get things going. So we'll take a look at the weekly chart here. And you'll see this is also a lot of numbers. What's encouraging here, and I've been talking about this, the ppm1 was deep into a downtrend mode just a couple weeks ago. It has flipped around. It was all the way down. Let me get the value for it. It was down at a minus 0.80. Looked like the end. We had the flash crash low, and then we rallied back, and now what we've set up is possibly a right shoulder and enough to get above the two averages that are going to be important is the 21, 1801.90 and 1797. So you can round it off to say anything over 1800 is going to be really positive. And I'm going to draw something in real quick while I'm on this run, is this is probably what's happening here is a right shoulder here setting up almost like a double bottom type scenario. But this is even a smaller one where we could see these prices start to move up. I like how they set up. This is a weekly, so we're starting to see this set up. This is the 1920 level I just drew across there. So that's going to be a major resistance point, but we're a long ways away from that right now. That's $160 away. But the pattern that we'll have to set up first will be a couple things. We'll have to see this get over 1800. We're going to need to see this PPM 2 turn up. PPM 1 is actually neutral right now. That's positive, and PPM 3 is turning up. So we are in the configuration for which a bottom can actually form in gold. And I think if we do get a bottom in gold right here, it's going to be a significant one, because I think the bigger pattern that's setting up here suggests that there could be a swing toward, back to $2,050, $2,100. That's not going to happen overnight, but it's definitely got a lot of potential. But we haven't signaled any of this yet. We've still got work to do. But magic number at 1800, I think you're going to be able to set up a large enough pattern to move forward. Okay, so good timing. I'm at around 45 minutes, so I should be able to finish. We're going to go to Bitcoin here. And a couple things I'm going to put on the screen so we can go through this. I just got to change a couple things up very quickly. I just want to change this one indicator to yellow so it'll be easier to see. Okay. So Bitcoin, I mean, I can't even begin to tell you this. This is a very bullish chart, and the swing is like insane numbers to talk about. But this thing looks like it's ready to roll. We're getting the issue that I have with the market grid is the market grid won't update on a weekly until after midnight tonight, and unfortunately, I won't be able to get that out until tomorrow's update on the market grid on our website. That'll be the first time you have it set up, but just know that it's going to start to project to this number, this yellow number here. Let me zoom in just a little bit. So you'll see the yellow number is 60,612. That's your major pivot. So there's going to be resistance initially, but if we close above that number, then the next minimum target is going to be 85,000 plus. And my expectation is once this pattern, if it does get signaled, that there will be a new update of the Fibonacci targeting. So for right now, I'm sticking with that 85,000 number. But look at the PPMs here. I'm going to slide them up just so you can see just the PPMs. The PPMs are all turning up. PPM 1, 3.41. PPM 2, 1.47 and 1.24. We're just waiting for some acceleration on PPM 3. We're even looking at the WaveTech 200 is about to turn up as well. And if that happens, then that's going to be just off the map bullish from that standpoint. And the absolute crazy targets, 106 to 119. That's 106,000 to 119. So this is a very, very big number. I know a lot of, but if you look at the angle of the markets here, of the moving averages, we have a really substantial trend going here. So just know that's the case. On the downside here, that 10-period moving average is going to be major support way down. It's way down, 47. 697. And let me just see when we get the update. It's going to be about $1,500 higher than that. So it's going to be 48.2 is going to be the magic number on the downside. So any declines down to there will be your buy the dip opportunity. Okay. All right, well, we got through everything, folks. Thanks for watching. I just saw a couple questions. Since bonds are bad at the moment, what would be a non-bond backed cash equivalent? Cash. You know, I know the term cash is trash. Cash is trash if you held it for multiple years. That's true. But the way that I have viewed cash always is it's a position, and it's okay in a short term to have cash on the books because it basically neutralizes your exposure to the larger market. So it just depends on what you're owning, and everything that I do on this channel and everything is based upon the process that I built, our portfolio management system. Like I said, most of our stuff's 40 to 60% in cash, and I would just be in cash. That's okay. You don't want to really own any bonds here, and I'm not sure that there's anything particular that you could use as a cash equivalent. I think cash is okay. Okay, so anyway, folks, that's going to do it for tonight's show. The replay will be here. We will tag it so that we have all the elements I talk about. I think it takes a couple hours for the video to render on YouTube. Once that happens, we'll clean it up, get rid of the music on the front, and get everything for you. So I just want to ask you folks, we got about 219 people. I have some good friends. I'm going to play an advertisement for you at the end. I didn't want to interrupt the flow tonight, but these guys have built all the computers, the ones that I'm using now, and everything for me for almost 10 years now. And they've given me opportunity to pass a discount on to you folks. So here's the thing. Here's the ad, and thanks for watching. We'll talk to you tomorrow night. Kendall here. Just want to introduce you to some friends of mine. I've been using the Digital Tigers computers for about 12, 14 years now. They make amazing machines. It's just an absolute must to have one of these. They also have the opportunity for you to use this with TradeStation. There's a rebate. They build some of the fastest conductivity and trading computers out there. They have a deal with TradeStation that you can get a total rebate up to $8,000 on a rebate if you're an active trader. You have to qualify for this, but all of this is possible. So make sure you go there and visit them if you're looking for a new computer, and use the discount code KENDALL5, KENDALL5. Thanks a lot, folks.